Yeah, you definitely can't underestimate what's about to happen to us over the next 5, 10, 50 years with the inventive AI. And as AI becomes more saturated through every digital interaction you have, and as your digital interactions become more predominant through all the interactions you have, it's like this becomes a layer that everything's going to be seen through. And this is like an absolute turning point. And if you're not embracing the tools and learning them, you're just going to absolutely fall behind.
Welcome to Startups Decoded, the show that gets real about what it takes to build a successful startup. I'm Andy Walsh, 2 times exited founder, strategist, and your host. Each week I talk with top founders, investors, and operators to unpack the plays that drive real traction, not just headlines. If you're building something bold, this is where you'll get the honest insights to scale with clarity and confidence. Let's keep growing together. Hit subscribe and share with your community. It would mean the world to me. Hello and welcome back to Startups Decoded. My name is Andy Walsh, and today we're exploring venture studios, but with a consumer-facing lens. And I'm really fortunate to have Mike Jones, who is the GP at Science Inc. Welcome to the show, Mike.
Thanks for having me, Andy.
I'm excited because I think that when we get into the detail here as far as what you do and the companies you've created, people will be very familiar with what you've built. And in the world of venture studios, which are evolving quickly and finding their way both from a consumer-facing perspective, but also from the investment side. But to kick things off, I'd love to learn a bit more about yourself and your path into venture, because there's definitely a pattern that I observe with guests on the podcast, which is it feels like there's nothing linear about their careers. Folks typically bounce between industries, between types of roles they do, and I feel like there's this breadth of skills that allow people to do what they're doing right now.
Yeah, I started my career pretty early, really as an entrepreneur, starting my own companies. I've always loved building things, and I always love building things with teams. So, when I wake up every day and think about what I'm excited about, it's really about building new ideas and building new concepts. In doing that, I've built stuff for myself. I've built stuff for other people. I've worked with early stage teams and built things. But from a path perspective, I built a company during college that I subsequently sold to AOL. I worked inside private equity where we kind of built up and sold different businesses they had. I came inside MySpace to see if we could rebuild and relaunch MySpace. And then I set up Science as a platform to kind of allow us to kind of build in parallel with entrepreneurs. The string for me has just been coming up with ideas, putting group people around those ideas and doing our best to kind of build interesting things within them. I've done that within different structures as far as like who owns what, but the core value is the same.
And for you, identifying new opportunities, I love looking at the process from an idea into launch. It feels like this year is just opened up a whole new world. Massive understatement, of course, as far as opportunities to create companies and how you do it. Where when you were starting, I'm always fascinated, like what were the insights you were seeing, what trends in market were happening to get started with your businesses?
Yeah, I think you're right. There's moments when there's like technology shift and that opens up opportunities to build things and sell things. So, for me, I became aware of that when the web was first introduced, and I happened to build a company that was actually kind of like an agency, kind of building software on the web. That was the first trend. The second for me was this Web 2 movement, which was really about making the web more social. So originally the web was this kind of isolated experience of me interacting with the website, but then suddenly there was these layers of social brought onto the web, whether it was finding your friends or chat rooms or presence or instant messaging, video, content, media, like how do you connect to others? So I think that was the second movement. And I built a company during that second movement and sold it to AOL because they were embracing that Web 2 social movement. The third in my mind was crypto, right? Once we kind of saw the blockchain come to fruition and this kind of big adoption around Bitcoin, there was a moment of obviously building it in that framework. Maybe before that, there was the mobile phone, iOS developers, and actually the open app store. So maybe that was maybe in there's the third and fourth wave, and maybe the fifth wave right now is obviously AI. And so you're right. Like if you're in a position to build things and you have concepts and you have team, around those movements and you execute properly, then you're in a really good point to sell businesses, because if you build at the right moment and that industry gets kind of disrupted or traditional industry gets disrupted by big technology change, they often will acquire their way into relevancy or acquire their way into defense. And I've definitely been the beneficiary of that.
And it feels like the thing that I'm seeing this year too is that companies are building quite often trying to get cash positive much sooner without investment. But it also feels like a little bit of a trend towards earlier acquisitions where you can create something, get enough market share, and someone who has a tech stack that's more well-rounded snap up these people. Rewind 10, 20 years ago, I don't think businesses would have turned around as quickly for many reasons, but that pattern I'm seeing. And when you're creating companies from a venture studio perspective, which we'll tap into a little bit more, in that early start, are you looking to create something that is both fundable but also can be set up for an acquisition?
Well, from a venture studio perspective, we're deploying other people's dollars, right? Because we run off of a fund with LPs, and those LPs give us dollars to take high risk but educated investments that have potentially long-term big outcomes, and long-term being a kind of 5 to 10 year basis. So we don't look for businesses that are like, we're happy to have businesses that are cash flow positive, but we're not looking to return capital through dividends. We're really looking to return capital through future exit, enterprise value, public stock sale, private stock sale. So yes, we see a lot of businesses that could be profitable at early stages, and we're obviously fans of those. I love those types of businesses, and I've done those types of businesses. But in many cases, from the venture perspective, we're looking for businesses that at a 5 to 10 year basis can get to a certain size and scale that then would allow some like larger acquisition and share transfer that then would allow us to pay out our shareholders or our LPs at a much greater basis.
That makes sense. And obviously LPs are in it for financial reasons. And like, obviously you want to be able to drive returns, but also there's the passion of creating a company, and you've had a huge success and household names that I've flagged before as far as a Dollar Shave Club and Liquid Death. I'd love to explore that. And Dollar Shave Club, I feel like came at a time when there was a lot of movement around D2C happening. That became a huge wave of companies that cut out the middleman, so to speak,
Mhm.
and you were one of those first ones. So you were latching on to something that is basically a very typical household item and finding a way to make it more economical for people on such a high cost item that's got a short shelf life as far as
Mhm.
usage at home. That process of creating something that is very focused on scale but also price, how do you go about thinking like with R&D and distribution and building out validation in that early stage to know that you've got something that can get traction plus also scale?
Well, I think if I pull back to the moment that we were looking at that deal, right, we were looking at broadly, to your point, this direct to consumer movement where people wanted to connect with the brands, understand the ethos behind the brand, maybe even the founder behind the brand, and hopefully have a better experience buying direct versus going through a store. We were looking at a lot of things. We loved anything that was naturally replenishment. So anything that you would consume or use on a very high frequency basis. We also like things where like the replenishment added to the experience. So if I sent you more of the product, you would use it more and you'd have a better experience, right? And obviously that's definitely true for razors. We worked with a lot of different founders at that point in time. And when we launched Dollar Shave Club, we had 4 or 5 other direct to consumer businesses that we also launched. And, some of those also went off and sold, but Dollar Shave Club obviously became the biggest. If you ask like why did it become the biggest, first is they had an epic founder who, delivered this groundbreaking video at a time when the question of like how will YouTube touch commerce was a really logical question. And that video kind of broke the internet at that point and obviously kind of launched the company effectively. The founder himself had a really good understanding of brand and how to connect to people through brand. And he kind of thought of himself very similar to the way some of our businesses do today, almost as an entertainment company. And how do we entertain our customers? The product was good. The product wasn't great, but the product was good and it was good enough. And what we basically found was like, if we sent you lots of razor heads, you swapped your razor more frequently and then you had a better shave. So we didn't have to be the best razor, but we did have to be the most available razor to you. It also was at a moment when razors inside retail environments were both really, really high priced, but also typically unavailable and that they were like locked up. A lot of factors came together for that company to find that really, really fast trajectory. And we ended up taking, a few points of market share from traditional players, then obviously sold the business to Unilever for $1 billion about 4 years in. So it was a super fast launch and transition and growth path. And it was taking that market share away from traditional competitors of one of the reasons why I obviously think M&A became a big driver for us. And we had really, really good direct to consumer economics. Like we were dominant for the kind of performance marketing, social content, and that drove subscribers. And and people love the product. And so a lot of factors came together for that business to work.
I'm came from a brand and culture background myself, and am a huge believer in the power of brand, particularly in the market today, where
Mhm.
building a moat is getting much harder. It's easier for competitors to build a replica business, and brand storytelling is really important to be able to build a personality much bigger than a functional product. And I look at what you've done with Liquid Death, and again, the perfect example of how creating a cult brand to stand out in a shelf, which is very cluttered. Like if you look at the seltzer market holistically, you go into a Whole Foods, I'm not sure how many brands there would be, but my guess is it probably would tip over 50, if not 100 brands
Mhm.
in that. But my observation as a consumer is that a lot of them are very feminine skewed as far as color palettes, etc. And to come in with a big can, bold name, bold brand, and the
Mhm.
story that goes behind it, immediately people are curious and they're building a relationship with the brand before they even try the product.
Yeah, I think that's true. And in today's world, if you are going to launch something into a competitive set like beverage or snack or food, you do need a whole different reason to talk to that customer. And you have to also think that when you're bringing that forward, you have different surface area to tell that story. So, like, if we're launching, for instance, like a new granola bar or health bar company or an electrolyte business or a food supplement or whatever, the reality is like the beauty of online is we can tell that story through social, we can tell that story through a website, we can give you a bigger reason, we can tell a true narrative around the brand. But the moment that that stands on a shelf, you have very little surface area to tell that story, which means either someone's got to come into the store knowing the story and they're reaching for the product to fulfill the realization of that brand, or you've got to have something super disruptive that jumps off the shelf and compels people to ask themselves, what is this? Why do I want to be part of this? Is this something that I want in my life? And both are really hard challenges. But I do find that I like launching these big disruptive brands online because I get more narrative. I get more room to basically tell a story, talk about the functional ingredients, the benefit, the founder story, why we think this product is better for you than the competitors. And I find that once we hit retail, it's much more limited and it's much harder.
Yeah. And in that early stage of building brand versus selling product, I think that tension that you get when you're a founder in the early stage and you want to differentiate and have a brand that has a personality and is known versus selling stock to make sure that you're getting revenue momentum. How does that thought process come to life when you're thinking about two? Because clearly your businesses that you've created have become famous beyond the product themselves. So it's been long term a really worthwhile strategy. And I think that it speaks for itself. But in those early stages, when you're being very conservative on spending and rationalizing every dollar, how do you think about that tension?
Well, I think on the conservative spending piece, it really has to do with the innovation of the CEO and the founding team, right? Like, especially with today's world of AI, it's like there's no excuse now for not being able to express your brand in a beautiful visual video format through completely AI-driven content and prompts. And anyone that's like, "I really can't tell the story without a $250,000 production budget," it's like the whole storyline's dead. So, like, at this point, if you have a story to tell, you need to be using the AI tools to tell that story, and I'm expecting you're basically doing it for $0. Like, I'm expecting you're coming to me with a full media view, a full content view, a full view of the brand that you're all doing through AI and AI generation. And if you're not doing it, your co-founder's doing it or your partner's doing it, but it's like you're coming with a full suite, right? There's no excuse anymore for not coming together with that. I think the other thing I would note is like I've definitely had bad products with great branding and great narrative, and they weren't able to be successful. But like we had a company that like I would argue had better branding and narrative than some of our current companies with beautiful storylines and in-depth worlds, and they were truly entertainment business, but the product just wasn't good enough. And we've always had really good products. And the founding team never could figure out how to tell the story, or they could never build that brand, right? They never found their voice, and that also failed, right? So you really do need two things to come together. You need a really, really great product, you need a big disruptive brand, and that big disruptive brand needs to be magnified and the voice needs to be told through narrative and storytelling and entertainment. If you can do that together, it works really, really well. But it has to all work together. One can't necessarily like make up for the other.
Yeah, absolutely. And I think that a brand may get you to trial, but if the product isn't good, retention is going to be low and you just churn people,
That's
which
exactly right.
becomes expensive. Yeah, absolutely. Double clicking a little bit then on Science Inc. Based off the success that you've had, I would love to unpack it a little bit. And for people that aren't familiar with venture studios, and a lot of people would be, we've had quite a few guests now on here, but ultimately you're creating a company from scratch. You're coming up with an idea, you're building prototypes, and you're funding it yourself to get it to a point where it then can grow in a more traditional startup sense. But the structure of your internal team can go a long way to building that success. And whether it's a technical product, it's CPG, different categories that you play in, to be able to, I guess, for you, think about the people that you need to have around the table. And you mentioned then the product versus the brand. What's the structure of your team to think about the breadth that you need to make sure that each of your companies that you launch from the studio has a trajectory that you feel confident that you can double down on and get confidence to launch and scale?
Well, the way that I think of our venture studio, right, is that we're co-builders. So to your point, like we are typically at the inception of the business. Maybe the founder has a prototype, maybe we're starting a company from scratch, maybe they have some level of market traction, but either way, we're early, right? The second piece is there's a nice, complementary skill set between the founding team and my team. On my team, it's fundraising, performance marketing, business development, at times legal, financial support. And then we have kind of day-to-day builders that are kind of like me, where like they understand how to build concepts from scratch. So that's the team that typically plugs in with a founding entrepreneurial team that might come in with a vision or a prototype or maybe even a functioning business that they want us to see if we can magnify and grow. Right. Those teams have to work together really, really well. Like the CEO of that company is being arrogant enough to think that they're going to defeat the world, but also open enough to realize that there's people like us that may have really good knowledge on how to accelerate the vision and make it go faster. So you have to be both headstrong and, open to education, open feedback, open to assistance. We get it wrong a lot of times. Right. So it's like we test about 30 companies per fund, about 6 to 10 companies per year. A lot of those companies get shut down at early stages, which is totally okay. We kind of work off of the assumption that no matter how smart we think we are, we're probably wrong. And we need to get to market and let customers vote with their time, vote with their money, vote with their email address, vote with their mouse, vote with their retention, app installs. But we really want to get concepts into the wild as fast as possible to understand consumer receptiveness, and just the general dynamics of the ad landscape, the competitive forces, platforms, acceptance or rejection of ideas, how social environment's going to go. So we really, really want external validation around these ideas to determine whether how we're going to approach it. Right. And so, yeah, so that's kind of how we structure the venture studio. And to your question, like, yeah, I mean, I have builders that work with me and they work with our CEOs every day. Some companies we're building from scratch ourselves. Other companies we're building hand in hand with an entrepreneur. We get them to market as fast as we can. We deploy dollars into these businesses. And then once they show some level of lift and we actually have conviction, then we'll go raise external money and really put fuel behind those businesses.
I was curious about that structure for the founder, co-founder, entrepreneur in residence. They have various titles, but getting them in early versus dropping them in once you have some momentum. And studios, there's not one size fits all approach. They're very different. It sounds like you have a combination of both, where you may have people in early doors thinking about, okay, how do we define a business strategy, go to market and get momentum from the start? And then maybe there are people joining a little bit later. But have you seen any kind of pattern as far as success on how early you get a co-founder in to drive the ship and take it all the way through?
I haven't seen a pattern. I mean, we've certainly had failures where we brought in the wrong person, maybe at the wrong time, and whatever ember that we had going around this like business like burnt out, and suddenly the flame was gone, and we weren't able to really continue with the business. I think bringing in management is really very business dependent. There's certain companies where, the CEO is the business and they represent the brand so deeply or the product or the service that they're not irreplaceable, but they're super fundamental. There's other businesses sometimes we touch where the CEO is super important, but the management team broadly is really important. And the business can be more supported by an overall team versus like a singular individual. So we look at businesses individually and say, okay, for this company, what's the personality structure of the right person to run this company? At what phase are they getting involved in? Is this more logistics operation business? Is this really a financial business? Is this business reliant on brand entertainment, content development? Is it product innovation? Is it formulaic innovation, marketplace? So like, we look at them individually. I would say like beyond, if you ask me like what are the lessons we've learned, we've definitely been cautious now. There's certain businesses we just won't start because we know we are the wrong people to start them and we haven't met the right person and we feel like that person has been really, really easy or early. There's other businesses where we have started them and said, we are the right people. We're not going to rush to put external management. Let's get this thing way bigger before we hand the reins over to someone else to run. Right. And so we're super sensitive about when we do or don't bring in management.
Yeah, that rings true based off conversations I've had and what I've seen too. Like the category of business, stage, momentum, there's a lot of factors that then influence what type of person you need to lead the ship outside of expertise and personality probably being the big two as far as leadership that comes in for that business to drive it. And the fundraising you mentioned before a little bit as far as you're obviously putting in early capital to drive momentum. What is your thesis as far as at what stage you want to get external investment? And then what does that process look like in thinking about getting some early traction where you feel like you can get some angel money, pre-seed money, whether that's individuals or VC companies? What's your structure there for how you typically like to be able to get scale and investment in those companies?
So I feel comfortable taking other people's money into businesses when I feel like I would put my own money into those businesses. So if I'm waking up one day being like, oh my God, I love this. I wish we owned more. That's probably the right time for me to go to my network being like, look, we have a lot of conviction here. Maybe we're at the investment cap on our fund, but we think other people should get involved here. We're pretty sensitive. I think early days with science were really fast to bring stuff to market and raise dollars and dollars and dollars. And, I think we had a bunch of mixed results there. Had some big hits like, Dog Vacay Rover was a big exit for us. Obviously, Dollar Shave Club and MeUndies was actually a good deal for us. Urban Remedy, we had a bunch of good companies in there, but we were really eager to fund externally. And now we're much more sensitive to it. We want to make sure that if we bring something out, it's something that we're really excited about because the moment we also take other people's money into a deal, the reality is we're signing up to kind of vouch for that company for like a long time. 4 years, 8 years, like it's a long journey. And so we're not very casual about, those raises. When we bring out a raise and bring external dollars, it really means we really believe.
One of the things I hear as well that becomes a little contentious where venture capitalists are skeptical sometimes of studios and the ownership splits and whether they invest or not. Are you seeing some similar patterns? It sounds like with the experience you've had and success you've had, you've got a good network of people that know you, trust you, as well as far as your success rate historically, which
Mhm.
obviously goes a long way. But are there barriers you think in the studio fundraising for a portco versus a traditional startup that is independently owned and operated from a founder?
No, I don't. I think that I guess you have to look at it from the lens of the investor, you're saying, like
Yeah.
yeah. I think the benefit of a studio is as an investor, if you look at a company that's coming out of a studio, you have some level of expectations over the way it's being governed and the way the company's been structured and the way the financial model's been constructed and how they're building their board. And, you probably have some higher level of belief that basically the company has kind of passed through a bunch of checks and balances. Whereas when you go to a company that's just been a pure startup, maybe they have no real oversight whatsoever. Maybe they have or have not like formulated that board. Maybe they do or don't have governance and standards in place. That's not to say that like one method is better than another, right? I mean, these are all just startups. So it's like you can have all the great construction and rails in place on a company and still have a complete failure. So it doesn't necessarily prevent that. Uh, but it does give you some level of comfort as an investor, knowing you're not walking into like a situation where there could be major fraud or really bad financial decision making or stuff that's going to make you really feel icky in the long run. So I think investors do take that into context, but the reality is like early stage, investing is a super hyper high risk, asset category. It's like you can de-risk it certain ways, but the reality is you're stepping into a pretty difficult place to win.
And particularly pre-revenue, there's a lot of instincts as far as understanding the category, the market,
Mhm.
and early patterns and signs. And I've had Notion Capital, Antler, Primary VC, a range of people that spend a lot of time in that early stage as well. And for each of them, as far as their own approach to how they're analyzing founders, analyzing companies, etc., is very different. And what they're doing. And interestingly, Jason Schumann from Primary VC was talking about a lot of their pattern recognition comes through relationships with investors who are Series A plus, where they're obviously have got more data, they've got the ability to look at success rate and conversions in a different light compared to those early stages. So for him, those relationships are critical to identify what is looking good that can go on to the next stage into a larger Series A plus investor.
Yeah, that's true. Like we have a lot of patterns, right? We have a lot of data that we go through to kind of determine the trajectory of our businesses and understanding whether we should or shouldn't invest more and where we have deeper conviction, which is one of the benefits of the studio oversight is that like, yeah, we do get to see stuff that normal people don't get to see because we're not just cutting a check and crossing our fingers and checking back in with the company once a quarter or once a year. Like typically we're on daily data with the businesses and we actually kind of see what the growth is looking like and what's working, what's not working. And that actually gives us greater insight into other investments we may or may not make. So I would argue that the more deals we do, the smarter we get for the next deal because we're compounding all that data and strong pattern recognition around it. In addition, because we're very sector specific and more specifically business model specific, we talk to a lot of the acquirers within the space. So we also have a sense from them what they're looking for and what they're hunting for. So we're, I would say that we're becoming better informed on the early stage, the top of the funnel of understanding what the early companies look like. But we also understand kind of for the later stage where that needs to be positioned to find our kind of ultimate exit of the business. And if we can take that knowledge together, I think it makes for better informed investing.
Yeah, absolutely. And the breadth of data is obviously a strength within a studio, that pattern recognition and looking at early markers in certain categories as far as growth trajectory, churn, CAC, all the things that you look at. Like having those very detailed and established, are you having benchmarks? Do you have ways to assess it where your validation process becomes quite automated? So you're able to get a pretty good gut check on where those businesses are at?
It's not automated, but we definitely have a gut check as it relates to specific types of metrics that we're absolutely looking for. It's like a business pitched me yesterday and they kind of casually mentioned a metric that's something we track really tight, very carefully. And they had kind of probably consider like a top 10% that we've ever seen in that very specific metric. And that drove me to kind of lean in and be like, I actually want to look more here. This is interesting. So yeah, so we it's not automated by any means, but it definitely gives us good road signs to understand what this business might look like.
Makes sense. And to fast forward to 2025, in the last 12 months, we're seeing companies created in brand new ways on new platforms, new categories are coming through. From a studio and studio thesis perspective, you've got strong history in CPG and other categories as well. What does innovation look like in the world of AI for your studio and the type of companies you're looking to create in 2025?
So, I mean, it obviously it touches kind of every aspect of our business. So certainly we're seeing businesses that only exist because of AI. So for instance, we just launched a business called the website's Join Mass Action. And it's basically it's a platform that monitors dark web data breaches off of your identity and then opts you into class action lawsuits with partnered law firms that we work with, right? Basically, we saw this massive increase in data and in dark web data sales. We want to find a way to get consumers paid. We can basically tee up everything through AI, which is what they're basically using, and then build an entire company based on efficient legal services through AI prep, essentially partnered with law firms. And that business we wouldn't have done without AI, right? So in that case, like we're seeing AI specific businesses. On the other hand, completely separate, we launched a business called Sorted, and that website's Join Sorted, and it's basically a home organizing business. It's not AI, it's a marketplace, but I will tell you that the cost it's taken them to build the website, create the marketing materials, create their Facebook audiences, figure out their email campaigns is the lowest it's ever been. So on one hand, we see businesses that exist solely because AI as an engine allows them to exist. On the other hand, we see businesses that are hyper efficient, that suddenly their cost to get to market is super low for us compared to what it was previously because they're using AI tools.
And I've got a lot of friends that have businesses and they're very, very adamant about bootstrapping because their overheads are much lower, to your point. Like the COGS just to get to market, to drive sales, retention, building platforms. You can do it really cost effectively with less people now. My first business, we got to 10 million annual revenue pretty quickly. But within that, we had 35 people, and some of those people were doing jobs that are really repetitious and things that can be automated now. So immediately I could probably shave 200,000, 300,000 of COGS straight off with a couple of $50 a month subscriptions.
Yeah. I totally agree. So now it's like when people bring me concepts, like I expect fully built out concepts. Like I said, you should be bringing me product renderings, strategic positioning, marketing imagery, brand imagery, videos, TV commercials, like the whole setup, right? And you should be like, yeah, this cost me like $25 in AI credits. And I'm like, okay, that's what I expect now. I don't want like some Word document with a bunch of text on it telling me what you're going to do. Like, show me what you're going to do. Don't tell me anymore. You don't need to tell me you have to hire a designer anymore. Eventually, you might have to hire a designer, yeah. But for initial prototypes, for initial visualizations, like you should be ripping that stuff out while you're watching TV at night. Yeah, I think today, our expectations as investors are way higher than it's ever been.
And you, in parallel, also do angel investments. Like, obviously, they seem to relate as far as the studio and you personally. Do you assess them differently? I'm always fascinated because for me, any angel investments, a lot of it for me is passion based. So I'm trying to find businesses that I believe in that I want to double down on, not just for returns, but because I believe in what they're doing. I believe in the founder. And then there's other times when I just look at a business that's got strong cash flow, good growth projections, low cost of operations, and I see it as a very turnkey way to multiply capital. Do you think the same way when you're looking at angel investments versus studio?
Yeah, I mean, I think I want to find, first off, is everything I try to do is obviously try to do it through science. If there's companies coming to me that are super late stage or they're just not appropriate for science's investment philosophy, I'm happy to look at it from an angel perspective. I do look at everything through the lens of returns. So I'm happy to go into a sector where I can learn something, but at the end of the day, like I'm in a phase of my life where like I want to drive massive returns. That's the goal. So you have to basically prove to me that, your angel investment is going to outperform my investing. And because when I invest into science, right? And invest into the science companies and science deals and science funds. And then I do a lot of public market investing. So if you can beat my return profile, I'm super excited. Right. But if you can't, I'd rather just put money into things I know. But I do look at a lot of stuff and I talk to a lot of companies. And I also look, to your point, at a lot of alternatives just to become a little bit more informed around it to see if there's more diversity that I want to do in my own, investing practice.
And I find that if you're looking at a lot of different businesses, you start to glean different insights and trends and patterns that help you holistically as far as where people are going, how they're doing it, tools they're using, etc. And I'm seeing that shift dramatically as far as the automation process we touched on with AI, but also
Yeah,
new ideas that weren't even possible 12 months ago because of technology.
totally agree. I love that.
Yeah.
That's excited. Yeah.
Absolutely. And then I'm always fascinated for you personally, and you've had great success with science, personally investments as well. I don't know if you could put your feet up and retire, but I've got a lot of friends who have had strong exits. They're independently wealthy now forever. They don't need to worry about money, but they keep going back and doing more. As far as Mike day to day, what are the things that you're loving about the work that you get to do? And is there a point where you feel like you could actually put your feet up and not have a full-time job anymore?
I mean, yeah, I love the work I do. What I love about it is I love, coming up with an idea and building new things, right? And seeing if our theories are possible, right? And so sometimes that's fun because it's my ideas. Sometimes it's fun because it's building someone else's ideas. And then if we get those things become big and millions of people use our products, use our apps, participate in our marketplace, consume our CPG goods. Like that's exciting for me. It's impacting the world in a way that I feel like I can impact the world. I do really well with building other people's dreams as well as visions of my own. So I just like building, right? I just get excited about it. It is obviously a full-time job. My days are pretty stacked. I love the learning aspect of it. So when I have sectors I'm curious about, I can go into it from an investment perspective and see if I'm interested. There's a bunch of sectors I spent time in learning about and decided I don't want to invest here, but I learned a lot through that journey. So I'm curious, and I just want to keep learning. And at some point, I would imagine I would do less of it. I think I'll do the same thing. I'll just do less. So maybe instead of 8 hours a day meetings, I'll do 6 or 4 or something but I'm not interested in pulling back today. In fact, I mean, I think I felt a little bit of a pullback during COVID, but then on the introduction of AI, suddenly it's like, I want to build more than I've ever built, right? It's like, I can't wake up, anymore. Every morning I wake up with like 5 more things that I'm like, oh my God, why aren't we building this? Because I kind of clearly see what AI is going to do to society in the future. And I just see all these pieces coming together. And the only question in my mind is who's going to do it? Are we going to do it? Is someone else going to do it? Who's going to benefit from it? Are they going to do it ethically or non-ethically? How are we going to approach it? So because I see that future, I definitely want to participate in it. I'm not ready to like stop that.
On a personal note, do you know any founders who have had big exits who have tapped out, retired, and are just living a very recreational life?
I've seen phases, a lot of times, like I have older kids, but I have a friend who I just had lunch with who had a really big exit and he has young kids and he's excited to, be a dad and just live in that young kid time span, which is beautiful. Almost everyone I know that tapped out eventually kind of came back, where it's like, yeah, they took a few years off or one statement is like, they didn't want to grow up. They didn't want to raise their kids in a world where dad was retired at like a really young age. And they thought that was just like bad, kind of just bad rule sets to set for the kids, like a bad example to set. But I don't have anyone that I know that's like completely removed themselves from building and never returned. Almost everyone I know came back and returned, and maybe they built their own stuff versus other people. Maybe they deployed their capital more differently. But I spent a lot of time with builders. So at the end of the day, people like to build stuff, like to build stuff. They don't typically lose that edge.
And you mentioned the word curious, and I'm hardwired. I just can't help myself. If there's something that I don't know, then I find myself immersing for hours. And obviously, the likes of ChatGPT make it much easier to digest content quickly, from long form video content to books, etc. But I think that it screams to me that a founder mindset is that curiosity and tinkering is always going to be there. I think a really good founder, and hence
Mhm.
exited founders, are founders who just can't sit still and are
Yeah.
hardwired just to want to do more and be part of something, be part of change. And to your point, we're at a wave that is completely unprecedented right now.
Yeah, you definitely can't underestimate what's about to happen to us over the next 5, 10, 50 years with the inventive AI. And as AI becomes more saturated through every digital interaction you have, and as your digital interactions become more predominant through all the interactions you have, it's like this becomes a layer that everything's going to be seen through. And this is like an absolute turning point. And if you're not embracing the tools and learning them, you're just going to absolutely fall behind.
Absolutely. I've got an 11-year-old daughter, and she's talking about college in 7 years' time. And I'm saying to her, I have zero idea what the world is going to look like in 7 years, what education looks like, what jobs will exist, etc. Like, it's going to be seismic. So I can't even give her advice. I feel like it's a little bit of edge
Yeah,
your bets, keep your interests and knowledge base broad,
I agree.
and then see where we're at that point in time.
Totally agree.
This has been fantastic, Mike. And to finish up today, I'd love to get a peek behind the curtain, if we can, from Science Inc. and things that you're working on at the moment, and anything that's particularly exciting you for the year or two ahead.
Yeah, let's see. I mean, right now we actually have a whole batch of companies that are in launch right now. So one is this company, Join Mass Action. Then that's super interesting. And we have an incredible dark web data team. We're learning a lot about the legal system, learning a lot about people's personal privacy and how we protect it. So I love that business. Join Sorted is fun. That's a new home, organizing business that we launched, which is basically a marketplace, a localized marketplace, which is nice and growing. We have a new community piece of software about to release that's half dating app, half kind of experience app, and it's not live yet, so I won't fully reveal it, but that's coming up. We have a big push actually into content content and animation that we're working on as well. That's kind of like a next generation type of animation studio with IP and content and our own distribution platform. So we'll be touching entertainment in a new way that we haven't really done in the past. And then, as the largest Liquid Death shareholder, Science is super excited about Liquid Death's launch into energy drinks, which they just talked about. It's a category that we felt like was super natural for them. The brand plays really, really effectively. Prototypes are super exciting. So we think that's going to be a major, major growth segment for that business. On the late stage side, we're excited about that. Early stage side, we've got a bunch of other stuff going on. And in the middle, we have companies that are, starting to, do their sales process and grow and find partnerships. And it's good.
It's really fascinating. Like the ability to find new ideas. You talked there around dark web and security and privacy and data. And I think it's going to be such a big thing. I did an episode recently with a founder who's got an AI security company that's helping young founders understand the risks that they have that they don't even know yet. So there's the old school Norton antivirus. Those kind of things can't keep up, where his business is very much looking at how do you have compliance and control and prevent any future issues. And that wouldn't have existed a year ago.
I totally agree.
Yeah, they're flying now. I'm so appreciative of your time today, Mike. This was so good for me. I could talk to you for hours and hours. I'm fascinated on what you've built. I appreciate you giving up the time.
Anytime. I'm happy to help. And, I'm really approachable. Like I'm on Instagram, I'm on obviously X, like I'm super active on LinkedIn. Entrepreneurs are highly encouraged to reach out to me. Generally we'll email most people back. So I'm always interested in meeting that next generation entrepreneur and see if it's a good partnership for us to build with.
Perfect. That's amazing. And I'll share details for Mike's social channels in the show notes as well, so folks can reach out. But we'll wrap up today. And thanks again, Mike.
Sounds great. Thanks so much, Andy.
Thanks for listening to Startups Decoded. If today's conversation helped you think differently, share it with a founder in your network. And don't forget to subscribe for real-world startup insights every week. We really value your support. If you're interested in partnering with us, email hello@startupsdecoded.com. I'm Andy Walsh. I'll see you next week.